Micron earnings, and Besant believes that the big beautiful bill is making its way through, and they probably will find a concession that they can agree to in the Senate for the SALT deductions. We're going to talk about those things and take your questions today on Open Interest. Hello, everybody, and welcome. Welcome to Open Mic. We are looking forward to taking some of your questions today. Tony Zhang was making some bullish remarks about Micron Technologies when we had him on the live stream on Monday, and I figured it made sense for us to provide an update now because the company just gave an upbeat forecast helped by demand for artificial intelligence equipment. Their fiscal fourth quarter revenue will be about $10.4 billion to $11 billion. That is well in advance of, or higher than I should say, the average analyst estimate, which was closer to $9.9 billion. Profits are going to be around $2.50 a share, which is going to be excluding some items, so that's not necessarily going to be a GAAP number, but the projection was for about $2.03 a share adjusted. They are seeing increasing demand for components like their high bandwidth memory, which is one of the things that Tony was talking about. And those are used in machines that develop and run AI tools. One of the points we were making is that it is not just about NVIDIA GPUs, and that it won't even be when we start seeing the migration someday to quantum, that even conventional chips are used in those applications. The company is expecting continued growth from that market, and also software, which becomes more complex and requires more memory. And the company is also starting to recover from narrower profit margins in the prior quarter. Shares were already up quite substantially, and we're up another 6% or so after hours after they made this announcement. So those numbers all looking pretty good. This kind of goes to something I just want to touch on very quickly, which was that we were talking about how cyclical stock valuations will oftentimes be lower than they are for the broad market. This makes sense because there's going to be periods when you see profitability and times when you see lower profitability or even losses. But one of the things that I think is an old saw that is commonly said about cyclical stocks, and that is that they always look most expensive before they rally, and they always look cheapest before they fall. And what that is alluding to is that oftentimes when you start seeing multiple expansion in cyclical stocks, that is taking place either because you're at trough earnings or that for whatever reason people believe that forward earnings are going to expand and they're going to be at their sort of other valuations when you reach peak earnings, and people are therefore expecting their adjusted EPS to fall. One of the things you can sort of take a look at here, if you're seeing my screen, is that you get these big gaps. This is just trailing earnings basis. I'll just throw in the forward look, which is going to be, I'm going to have to shorten this up a little bit because we had a period where people weren't expecting any earnings. But this sort of gives you some historical context for how it was looking as we approached these numbers. And you can see that it was trading at around 18 times forward, which, ignoring these areas where there was no earnings at all, you can see this was actually the upper end of its range. What was going on? Clearly, a lot of people who were looking at the stock ahead of this observed that they thought the numbers were going to be better than expected, and indeed they were. So the other question, actually, I'm not going to get to that question. I just put this up on the screen accidentally because I did mention that I was going to talk about the SALT deduction quickly. If this bill passes both houses, I think we can view that as a positive. The biggest stumbling block, as it stands, has apparently been the SALT deduction, the state and local tax deduction. So in the first Trump administration, they passed some tax cuts, but embedded in that were the reduction of, part of the revenue offset was going to come from the fact that they were going to have the federal government subsidize less state and local tax by reducing and capping the amount of deductions that people could take on their state and local taxes. So if you happen to live in a high tax area, like most of the eastern states, so Connecticut, New York, New Jersey, obviously those are high tax areas, and where I live in California. We have the highest marginal income tax in the country here. And so if you lived in these areas, even if the rate on things like your property taxes were not as high as they are in some other locations. For example, New Hampshire has no sales tax, it has no income tax, but it has a very high property tax as a percentage of the property's value, because the property values in some of the coastal cities also tend to be higher, even though the marginal rate on that might be lower. The rates are still very high. So around here, I don't know what the median house in my zip code is, but if somebody said it's, I don't know, $2-3 million, that's probably reasonable. The tax rate, if you purchased a house, there's a very unique situation here called Prop 13, so that if you lived in California for a long time, there's caps on how much your property taxes can rise. But let's just assume that you're moving to California, you're just coming here now, you buy a house for $3 million. The state taxes and then the local incremental things that you can have added on are going to be about 1.25% of that. So you're going to be dealing with, something in the neighborhood of, we'll call it $36,000 a year in property taxes. And if you make, a decent income, you're going to have a very high income tax as well. So this is a big issue in states like New York, Connecticut, New Jersey, and California. And of course, these are very populated areas as well. The problem is that if you increase that SALT deduction materially, two things happen. One is you lower federal tax revenues. And then you also have a little bit of a moral hazard, because it does encourage state and local governments to essentially increase their taxes because it's partially subsidized by federal taxpayers, which is a little bit questionable. So where does this leave us? The real difference of opinion has been that the House fought and slogged to get the state and local deduction cap raised to $40,000. And I believe they have a phase out for people who make more than $500,000 a year in income. There were many in the Senate who wanted to keep the state and local tax deduction cap at $10,000, which is where it currently resides. $10,000 deduction, from my perspective, isn't much, because it is very easy in a high tax area. First of all, I would say that in most areas, it's not going to be difficult to hit that $10,000 deduction in any case. So even if you live in a relatively low tax place, just net of inflation, rising wages, rising costs, and things like that, I'm assuming that most working families or couples are going to hit that deduction pretty quickly. So I don't mind seeing it go up a little bit. On the other hand, I can completely understand why people in lower tax jurisdictions don't like the idea that you expand it so that people can raise their local taxes, take the benefit of those increased revenues locally, and then deduct it from their federal tax burden. So it sounds like Bessent believes that they are very close. If they haven't pushed it across, it sounded like they had some kind of an agreement in principle. I mention this because if it looks like that bill's going to get through, I think the markets will view that quite favorably. And I think that's going to be viewed quite favorably for another reason. I don't want to get too much into the political side, but Senator Murkowski, there were some stories out earlier today that suggested that she intends to caucus or is contemplating caucusing with the Democrats going forward, which would, of course, reduce the Republicans' majority, which is already very thin, in the Senate. And why is that important? Well, from the perspective of investors, the thing that you're wondering about is whether or not Congress is going to be able to get anything done, particularly is it going to be able to get anything done that is economically friendly, business friendly, is going to help reduce regulatory burdens or improve the tax circumstances. With narrow and then slimming majorities in the House and Senate, one might imagine that creates some concerns on that front. We also discussed on Monday the fact that the S&P, and it appears to be sort of bumping its head a little bit, approaching its all-time highs. We're basically right there, and it's kind of slowing down. So let's just draw a quick line so we're serving as a reminder. I do want to say that I still remain generally pretty positive here, but I do think this is going to be a pretty true test where we are right here. So this difference, let's see what this is. I mean, we are right there. I mean, we're looking at, yeah, we're within 1%, I guess, now of the S&P 500's all-time highs. And the technology sector, which was actually what we were talking about on Monday, has actually already broken out. So is this going to lead the rest of the market? That's certainly one possibility, and it can drag it, right? If the biggest companies within the tech sector, which are the largest market cap companies anyway, are breaking out to new all-time highs, then it would make some sense that it's probably that, you know, we're probably going to get there for the S&P. My view is if we bump our head up there a couple times, we can see that the technology sector did exactly that. It kind of consolidated up here for, I mean, looks like, you know, 6 or 7 trading days. We might expect to see something similar before we get that potential breakout. Not a terrible idea given the fact that the, you know, VIX and other measures of implied volatility have fallen as things seem to have calmed down a little bit in the Middle East. And, you know, we're approaching these all-time highs and we might get something through Congress. If we start seeing that VIX get down to sub 16, thereabouts, and we're bumping our head right there, not a terrible idea to buy some cheap put spreads. I talked about this in XLK where I was buying some, you know, I have it actually in the S&P, but I have some cheap downside puts, just a little bit, just so that you can maintain your longs. And in fact, in my case, I leaned a little too short delta. It's clear. And it was a little bit inconsistent with the view that I have espoused, which was that I did think that we were going to get to the all-time highs. Whether or not we were going to get through it, time would tell, but I just wanted to make that that point because I think it's something worth talking about. So let me get to some of these questions here. So Tucker D. Dog says, do you ever do conversions and reversals? Are those strategies ever done by retail? Are they ever done by retail? That's a good question. Have I ever traded them? I most certainly have. I absolutely have done them. In a retail context, have I done them? No. I have not done them in a retail context. So for anybody who's wondering what a reversal or a conversion is, let me just quickly construct that. So what Tucker D. Dog is referring to is trading synthetic versus common. So you can buy stock or you can buy stock synthetically. So I'm just going to create that right here. Doesn't really matter. I'm going to take, this is, we're looking at, because we talked about it on Monday, you know, for whatever it's worth. We were talking about Circle Internet Group. Actually, there was a situation where I did, now that I think about it. And I actually wrote an article about it. Okay, so good. I'm glad you brought this up. But it's rare that you would do this. But let me just first provide an explanation of what a reversal and a conversion is, and then why professionals use these structures and what it is that they're actually trading when they do, and if or why a retail participant might consider it. You usually probably won't have to, but here's some things to think about. Okay, so one of the things you could do is, of course, you could just buy stock. This is the risk-reward relationship of buying stock. 45-degree line. Goes up 1%, you make 1%, goes down 1%, you lose 1%. Pretty straightforward. We all know how stock behaves. You could also sell it, right? And we just flip this around, and you get a diagonal line that's just going in the other direction. Goes up 1%, you lose 1%, goes down 1%, you make 1% on a short. Again, very straightforward. What is a synthetic? A synthetic is when I essentially take on a similar 100 delta trade, but I use options to do it. How do I accomplish this? I buy a call and sell a put of the same strike and expiration. And look at this. Well, I should put this back to the buy so we can see that. So here we are. This is a synthetic stock position. Up 1%, make 1%, down 1%, lose 1%. Why is this buying an at-the-money call and selling an at-the-money put of the same strike and expiration synthetic stock? Well, here's the way to think about it. All right, so in this particular example, it's the August 195s. If I held this all the way until expiration, if I'm long the 195 call and the stock is above 195, what happens? Well, the call gets exercised and you will purchase the underlying stock at $195. What happens if the stock falls? If it falls through the 195 strike, your short put will be assigned and you will buy the underlying stock at the put strike, $195. So no matter what, you're going to own the stock at expiration at 195. Now there's a little wrinkle in this, which we're going to ignore for, because of the complexity. If the stock landed exactly at 195 on expiration, then neither the call nor the put would be automatically exercised. And in that case, you could either elect to exercise your call, or the people who were long the puts could elect to exercise. So there's that one little bit of wobbliness, but we're going to ignore that because that's a little bit wonky and academic for this part of the conversation. But effectively, between now and expiration, this is going to behave a lot like stock. How does this compare to the actual stock price? Well, we take a look at the price that we're paying for the call and the price that we are collecting on the put. So in this case, you are paying $38.60 for the call, and you are collecting $39.65 on the put. So you pay out $38.60 and you collect $39.65. So net, you collect $1.05. So you can add that amount, the negative $1.05, to the strike. And that gets us to $193.95. $195 strike minus $1.05 is $193.95. So effectively, if I bought this call at $38.60 and I sold this put at $39.65, then as of August expiration, I'm going to own the stock at $193.95. Where did the stock close? $198.79. Okay, so it's about $5 higher. Why is that? What's going on here? Well, the short version is that if a stock becomes hard to borrow, you will find that you are going to have to account for the cost of borrowing the stock to sell it short. And you're going to see that the synthetic stock is going to trade under, right? So in a normal, what we call good collateral, or a stock that's easy to borrow, so that, securities lending desks just basically trade it like any other sort of collateral, then essentially what's going to end up happening is that the embedded rate is not going to be a negative rate as it is here. It's going to be a positive one related to the risk-free rate. So the synthetic, if there is no dividend, would usually trade over the stock, not under, as it's doing here. So this is the circumstance where rarely a retail trader might consider using options to get long a stock rather than using the stock itself. If you knew with certainty that you wanted to own the stock, you might essentially construct a synthetic forward contract, which is kind of what you're doing here, and trade the synthetic instead. So if I go further out in time, you're going to see this rate impact is even larger. So still with the 195 strike going out to October, so the 114s, now the difference is 45.25 for the calls versus 52.70 for the puts. So now we're looking at a difference of about $7.50. So that's $7.50 over 114 days on a nearly $200 stock. So that's 3.77% over 114 days. So that's essentially getting the stock at a 12% discount annualized. And so we can actually calculate what the market's implied cost to borrow the stock is by taking a look at where the synthetic is trading relative to the common, right? And that's the case here. Obviously, if there are dividends, you have to account for the dividends, and you calculate the net present value of the dividends into this and all that. That's not the case in this particular stock because it doesn't pay one. So, number one, so a reversal and a conversion. So now we know what synthetic stock is versus the common. A reversal is when you swap a common position for a synthetic position. So if I went to somebody, and the way you actually make a market in these things, or quote the price, is you quote the price as a net debit or credit. So in this particular case, I said it's about $7.50. You would say it's $7.50. If I was making a market in this thing, I might say, okay, I'm $7 at $8, pay to convert. Meaning that if somebody wanted to do the trade, swap synthetic for common with me, I would make them pay me $8 to actually get the common and deliver the synthetic to me, and I would pay them $7 to get the common and to give them the synthetic in exchange. And the way that I would expect to make money on that trade as a dealer would be that I would expect that I would be able to loan the long shares. If I paid $7, my expectation would be that I'd be able to lend those securities at least at that number, and probably a slightly better one. And that my cost to borrow the shares would be less than $8 if I went the other way. So I hope that makes some sense. But from a retail market participants, why would you ever care about this, and why would you ever do it? The only reason you would do this is because you happen to be using a broker who, if you own the stock, is not, for example, and you want to own the stock. So let's say you own 100 shares of this at $198.80, where the stock is currently. You have no intention to sell it, and you are not being reimbursed by your broker because you're holding those shares most likely in what's called street name. So if you actually own those shares and they are in your name, like the corporate registrar has your name on those shares, well, those securities are not going to be lent. But if they are in street name, like you have your account at Morgan Stanley, they are essentially, it's a ledger entry. The bank knows you as the owner, but the street knows the bank is the owner. And then the bank's lending desk is lending out those securities. And because they're lending out those securities, they're getting the short interest to lend it, and you're not. How do you correct this? Well, you could reverse, and you could own the synthetic, and effectively you would own the synthetic, in this case, at a $7.50 discount to the prevailing share price, and you're essentially going to collect that effective interest rate, which is 3.5%, on your long exposure to Circle Internet between now and October expiration. So that would be the reason why you might do something like a reversal. But as I'm saying, this is uncommon because it is pretty infrequent that retail market participants are so concerned about the price for lending short stock in positions where they know that they want to hold a long position for a lengthy period of time. And that's the thing. The longer out in time you go, if this stock is hard to borrow now and it becomes harder to borrow, this divergence, that $7.50 divergence, could become even greater. I've seen circumstances where, and that's why I remembered at the last minute, I was like, oh yeah, I remember a time. GoPro. I can remember when the GoPro forward was 35%, and I'm only talking about like 100 days out, was 35% lower than the spot stock price. So there's a couple of takeaways from this, by the way. You can look to the options market, back out, even if you didn't have any other tool to do it. Now, if you're on Interactive Brokers, you can actually look up this, you can check what the stock loan rates are, and you can find out whether a stock is hard to borrow and how much it costs to borrow it. But if you did not know, and all you had was Yahoo Finance or something, you can still go and take a look at the options montage, price out the synthetics going out in time, and you could back out, just use a spreadsheet or a calculator and figure out what the implied rate to borrow the stock is. But understand that those rates, just like anything else in the market, can change. So if the cost to borrow, if the stock becomes harder to borrow, the divergence between the synthetic and the common is going to widen. And as the stock becomes easier to borrow, it will narrow. So this trade, if you did this trade, so for example, let's say there was a catalyst upcoming and you thought the stock was hard to borrow because of that catalyst. What would that catalyst be? Let's say there was a big block of restricted internally held shares that was about to be released and was no longer restricted, which commonly happens after an IPO. There's a whole bunch of people who were awarded stock grants. They are restricted from selling their shares immediately after they IPO, but at various points in time, they're going to be allowed to sell those shares. And when all of that new supply comes on, there might be people who are anticipating that the stock's going to fall in anticipation of new shares hitting the market, all that restricted stock. And so what they will do is they'll short the stock in anticipation of that. But the flip side is that you know that once that restriction passes, the cost to borrow the shares is going to drop, right? Because everyone's shorting it in anticipation of all of that new inventory. So your trade might not necessarily be a directional one. If you had access to the shares, you could do a reversal like this, and you could say, okay, well, I'm just going to flip into the common, knowing that that 3.5% interest rate is actually not a 3.5% interest rate all the way until October. It's a 3.5% interest until the share restriction is lifted. Call it, the fourth week of August. Bang, I'll take my 3.5% and I unwind the trade. Okay, so this is a pretty inside baseball question from Tucker D. Dog here, and I apologize to anybody who was having a little bit of trouble following that. It's pretty straightforward math to figure it out. If anyone has more interest in that, you could put your questions in. I'm going to move on from the topic because I know that some people eyes are going cross listening to this, but I just wanted to sort of straighten that out. But there are reasons why people would do that. There are reasons why anybody should care. If you have something like Interactive Brokers, which has a very transparent securities lending within the platform, this is less important. But if you're using something, I don't use Robinhood or Webull or something like that, and those might be very good platforms, and they might elucidate these issues really well. But if they don't, or if you find yourself in a situation where you're sitting on a beach and the only thing you have access to is Yahoo Finance, and you think a stock might have become hard to borrow and you're trying to figure that out, you can do it just by calculating the options price. You take the call price plus the call premium, the put and the put premium, you deduct that, and you compare the result. So strike plus call minus put, that's the synthetic stock. Compare that to the actual stock. Most of the time you're not dealing with dividends, but if there are, you have to calculate the net present value of the dividend. Do that math and you can see if the reversal's trading over in a stock that doesn't pay a dividend by about the risk-free rate, it's probably GC, good collateral. If it's trading way under, it's probably hard to borrow. And if it's like a 30 or 40% discount, then it's probably close to impossible to borrow. So little sort of insider tricks of the trade for those who are interested. Did not expect that question. That's an interesting one. All right. So good morning, Mike. Yeah, per our discussion Monday about Micron, the market is liking its earnings so far. I know not to spend any profits until the trade is closed. Yeah, definitely true, but it does seem like this secular trend, and we've talked about this on many occasions. People keep talking about this AI thing like it's coming to an end, and then those companies that are actually doing the largest capex in the space keep saying that they're upping the numbers. We talked about it last week when we said that Zuckerberg was going to pay some people into his super AI group. He was looking to hire 50 people and pay some of them up to $100 million a year or some crazy thing like that. That doesn't sound like we're at the tail end of the trend, right? Okay, James Forbin. James Forbin, by the way, you made a comment. I saw that you were talking about movies from the 1970s, and I saw that the movie that you were talking about actually had your name in it. I don't know whether that was just strict coincidence, but that was interesting. It was a War Games movie, Colossus, the Forbin Project. So I had sent out a tweet related to Whopper, which is from the movie War Games, and you came back with that. I thought that was kind of interesting, and I didn't know whether there was any coincidence that your name happened to be related to the name of the Colossus movie. I respond to a lot to you on X. Yes, I've seen that. But this one in particular, I thought there might be other people who are watching this who are interested in War Games, the movie War Games, what's going on in the Middle East, and the fact that you mentioned this movie, which I noticed had a very low box office at the time it was released. It was, I think, in the hundreds of thousands of dollars. But it did seem like an interesting movie. So Colossus was the name of it. It is not about Hercules. It is a movie about war games, and it does seem pretty interesting because there were two computers, one developed by the Soviets and one by the United States, if I remember this correctly, and they end up communicating and gaining intelligence, sort of taking control of the world. Okay. So you said last week you talked about FedEx and discussed some trade possibilities. I shorted it last week. FedEx tanked this AM on guidance. I closed the short within 15 minutes. Great profit. Thanks. Yeah, look, I mean, this is a company. So one of the things we talked about, and I mentioned this because it stung me so badly in 2022 when they had their worst quarterly earnings release in 40 years, something I've referenced on this channel many times, because when you get kicked in the teeth like that, you don't forget it. And the comment I made about FedEx, which I have thought was historically a better operator, especially around peak periods like the holidays than UPS, that was my view. My thesis at the time was that the secular tailwind that was propelling delivery business was going to be maintained. So this is before tariff talk, and but the fly in the ointment there was that, and I've referenced this as well, suddenly you start seeing the trucks pulling up outside your house with all of your Amazon packages. They don't say UPS. They don't say FedEx. They say Amazon. And like I said, those are often contracted companies, but it doesn't matter. The money's not flowing to the legacy, the big two legacy companies. And also those logistics businesses, they really were struggling on an international scale. So you had DHL as well. It was kind of a messy situation. I still, I think they're decent businesses, but yeah, I just don't have much interest in owning FedEx or UPS because, and now we've got a whole new thing coming on the scene, right? So we've got self-driving vehicles. We've got drone. Actually, a friend of mine is who did work for the self-driving company Cruise is now working for, or he's going to be working for one of these drone companies on the delivery front. So it's a rapidly evolving space, just something to think about. And I don't know how the legacy players like FedEx are going to do in this space. Steve Garcia, you mentioned institutions selling deep in the money puts with short expiration, noting it's tied to conversion, if I recall. Can you explain conversion and why these trades may not be significant? Okay. Just right after I said I wasn't going to talk about conversions. Yeah, so when you see big blocks of calls and puts of the same strike and expiration trading at the exact same moment, you will often see a big block of stock trading, and these are these types of trades. They are, one side's reversing, the other side's converting. Like I said, all that's doing is swapping synthetic stock for common or common for synthetic. It's a carry cost trade. There are other reasons why people do it. Again, I don't want to get too into the weeds. Dividends are something that a lot of folks also will trade. It's an OTC market, so they're called dividend swaps. It's very common to trade them over the counter. It's kind of a fixed versus floating. So I'm sure you guys have heard of that in the fixed income space, fixed versus floating. So what you are going to receive in actual dividends is floating. We don't know exactly what's going to happen. We have a sense of dividend growth through time, but there are risks, right? So sometimes shorting dividends is it can be kind of a catastrophe tail hedge trade. The way to think about this is, remember what happened in the GFC. All the financials suspended their dividends. A lot of other companies did too. So if you were short dividends, which is to say that you bought a dividend, you bought a fixed and then sold the float, then when that diverged, you would expect to see a big profit, right? Because the counterparty to your trade owes you the implied rate of dividends at the time, and you owe them the actual dividends at the time. So if everybody cuts their dividends like they did in the GFC, it's a windfall profit to you. So people can use these things for all kinds of purposes. And that's one of them, right? So these types of trades often go on, but it's not something retail needs to focus on too much. This is also another quick point I want to make. I'll bring in two things. So there was a tax treatment issue that came up many years ago, and it didn't get appropriately captured into ETFs. So what had happened was companies started accelerating dividends because they thought a higher tax rate was going to show up in a subsequent tax year. So they were going to accelerate their dividends. So a lot of people started converting in the ETFs because they figured, well, if companies start accelerating the dividends, they're going to pay more dividends this year than we expect, which means that the true dividend in the common is going to be higher by the end of the year than the market implies. So I'm going to convert. I'm going to sell synthetic, buy common, and then that's essentially a way to get long float, short fixed, right? In terms of dividends, right? So it's not a dividend swap, but it's the way you would do it if you're just a retail guy saying, I think this is going to happen. Why do I mention this? Because that seems intelligent, seems creative. These things were trading in size. And a couple of the big bulge bracket banks, what I'm going to tell you right now is not going to make you feel much better about the market, I'm sorry to say. A couple big banks got on the wrong side of that. They're like, oh, great, people are paying us up to convert, and they were taking the other side. And then, a couple weeks into it, somebody inside the bank's like, wait a minute, why is everybody trying to convert in these ETFs anyway? And then they sort of reverse engineered what was going on, and they realized, oh my God, like we just gave all this money. So they started lobbying the exchanges and the OCC, and they wanted to make it so that the options contracts would adjust for these kinds of unusual dividend shifts, because special dividends get a special dispensation within the options rules. So you can't speculate on special dividends, but you can speculate on shifts in dividends. And the only reason I bring this up is because it still rubs me the wrong way that institutional market participants essentially move the goalpost after the fact. As it happens, in the grand scheme of things, it didn't make a huge difference because some of the tax changes that had been proposed didn't go into effect. But that did not change the fact that some big players still got some favorable rule shifts. There are a lot of people like Cliff Asness at AQR who's upset, for example, about how I think JP Morgan managed to finagle some rule changes on the LME a couple of years ago when the copper markets went completely sideways. This kind of thing just irks the hell out of me, as it surely irks most of you, and it should never happen that people get to change the rules while the game's being played when they realize that it's not going to work out for them, but sometimes it does. By and large, the markets are a much fairer place now than even when I first got into the market. They were a fair place then, but they're fairer now. But every now and again, we see this kind of nonsense going on. If you see a lot of these reversals and conversions going on, I wouldn't get too caught up in it, because if there's a real good inside play, I'm not 100% sure that it's going to end up, not getting, that somebody doesn't put their fingers on the scales anyhow. But use it when you're not getting fair compensation on the short rebate side for stocks that you want to be long. Alex V., Wall Street Journal, 2 Invesco ETFs are looking for companies that had reduced their share counts by at least 5%. Reduction of the company's share count will lower the number of shares and raise EPS. Good strategy. Well, I mean, I guess a lot. They've drawn. So they're saying they want a. Here's the way to think about this. It's not a bad strategy in the sense that investors care about buybacks because buybacks are accretive. Employee stock grants are dilutive, other types of, so increasing the share count is dilutive, reducing the share count is accretive. So if you buy a share of stock, I buy a $100 share of stock and it's paying $5 a year in adjusted EPS, and it's growing revenues in line with GDP. So let's say the top line is growing at 2 to 3% a year. So is it a growing company? Well, it's basically treading water with the overall economy. Rising tide lifts all boats and all that. So if the economy grows by 3%, maybe it rises by 3%. If it's flat, it's flat. Let's say that they do find that they have some year-on-year marginal incremental operating improvements so that their adjusted EPS growth is about 5%. Okay. So now you're buying a company that's maintaining its market share with respect to the economy, and it's growing its EPS by 5%. Growth company? Not necessarily, but we're liking what we see so far. But if the company has good free cash flow, and they're buying back shares by 5% a year, your adjusted EPS, even if net income is only growing by 5%, is now going to grow by more than that. Because, if the company was going to make $1 billion and it had, 200 million shares outstanding, right? So that's where you got your $5, $5 in adjusted EPS. And next year it's not going to have 1 billion shares. It's going to have 950 million. Well, now you've just gotten more adjusted EPS growth, right? So it does make sense in that sense. I like to see organic growth better, because real organic growth speaks not just to how much earnings you get to own, but sometimes it also speaks a little bit to pricing power. Like, take a look at what happened to NVIDIA, for example. NVIDIA started to see explosive top-line growth, and their bottom line grew much faster. So that much faster component... Oh, I just saw something about... Okay, no, I'm just making sure, because I saw something about dividends here, and I just want to make sure I didn't miss the question correctly. So what ends up happening is their products are in such high demand that they had real pricing power, and their margins expanded still further. So there's different kinds, adjusted EPS growth, great, because that's how much you as a shareholder get for each share that you own. So if the share count's going down and there's some organic growth, but if you see really fast growth and market share growth, then that probably speaks to a competitive advantage, and that means that the margin expansion component is going to be even better. So, and this has a nasty little side effect, right? So you can take a look at companies, and you're going to say, hey, look, if all you did was look at the EPS growth, and EPS is growing, let's call it 5% a year, and you say, 5% adjusted EPS growth, and the economy is only growing at 3%. That's pretty good. And then you look at revenues, and revenues are dead flat. And the whole reason you're getting the adjusted EPS growth is only because of stock buybacks, but the company is shrinking in real terms. So does that mean the company's not a good buy? Well, if you're getting it 10 times earnings, it might be a very good buy. But if you're buying it 30 times, that's not so hot, because the company itself isn't actually growing. And you only get to play that game for so long. So is it a good strategy? It's not a bad strategy. Buybacks are accretive. It's as simple as that. But does that make it, is that the only filtering criteria I would use? Yeah, it's not. But, they're looking, this is, so Alex, just put a pin in this one. It's a strategy to help filter a big universe of prospective investments down to something that's more palatable. And it's, it does create another sort of measure of support. You're looking at companies that are reducing their share count. So you have, by virtue of the fact that you've used that as a filter, you have at least one accretive element going into it. So it's not bad. Does that mean it's going to be successful? Unfortunately, no. Wish it was that easy. Mike, I have CRCL and July 150. I have CRCL, Internet, and July 150 calls against it. Oh, okay. So you're short. I'm guessing you're in a buy, right? The 150s. Those. Is that right? Because the stock, or yeah, those calls are in the money. So am I? So PC, if you could just clarify, I just want to make sure I've got you right. I have CRCL, Internet, and July 150 calls against it. The bid ask is wide, which it would be because those things are $50 in the money. Have had a good till canceled order for $149 credit for a while with CRCL on loan. Wanted to cash out, buy back the call first. Your opinion? So, yeah, here's the thing. Because the stock is hard to borrow, the only thing that somebody is going to be willing to do with those deep calls is they would have to buy the call. So a market maker would have to buy the call and short the stock. They are going to get, if they don't hold the stock already, they have to pay to borrow it. If they own the stock, they're not getting the rebate because it's hard to borrow. So that means there's a cost, right? So the best they're going to do is pay parity. That's the best circumstance, because you buy the call, exercise it, and you're in the stock. And it's so if you can get the thing for slightly under parity, that's why when you see stocks that are really hard to borrow, this is a game that gets played. And actually this I was in a trade like this. It was Goldman Sachs London was on the other side of it many years ago, and they ended up selling me like 500 calls, well under parity, and they were American style calls. I was like, what is this guy doing? So I bought the calls, sold the stock, exercised the calls that day. And I think I've told this story once before. It was a 500 lot. I expected delivery of 50,000 shares, T+1. And I didn't get the stock because the stock was impossible to borrow. And there was a big buy-in and big rigmarole. So not hugely important. But oh, wow, look at you. You were allocated at $31. Good for you, man. Congratulations. You come to San Francisco, take me out to dinner. That's a nice win. You are going to be able to, you could unwind that whole package by putting it as a package slightly under parity and just be done. Put it in as a complex order. You probably don't have to go more than a nickel. Pay a nickel to get out of it if you want to. But do a nickel under, and somebody will probably trade it on the Philex where they've capped out their exchange fees, so there's no cost to do it. And I don't know how much you were allocated, but once upon a time we paid 5 cents, even as an institution, to execute stock anyhow. That was like the going rate. It was the $2 brokers, as they were known. That was the discount rate, right? But the wirehouses were going to charge you a nickel. So what's it in? Do you want to pay a nickel to get out of it? I would say why not, right? So I would put it in as a package. That way you're not going to take any, assuming you don't want to take any short-term delta risk. You're locked up anyway, right? Because these things are all trading at parity anyhow, right? So it's $150 stock to you no matter which way you slice it, because you're already done. So I would just, if I were in your situation and I didn't want to look at it anymore, give the market maker a nickel under parity and do it as a package, and the whole thing will go away. Okay, so DJ, what do we got here? Hi, Mike. For someone with solid fundamental knowledge of options market, what would be your suggestions for advanced learning? I guess that depends on what you consider a solid fundamental knowledge of options in the options market. So when you say a solid fundamental knowledge, does that mean, you know what calls and puts are, you understand the fundamentals of securities lending, you understand synthetics, you have a basic or reasonably solid understanding of volatility and options models and how options are priced? Are you looking for more nuance into the underlying process of behavior for the underlying asset and how that impacts options prices, calls versus puts? Do you have a good understanding of skewness and kurtosis and things like this? Or are you going even further and you're really looking for cross asset and cross volatility stat arb opportunities? So I don't know what advanced means to you, but let me start with this. If I was going to go through a list of books that I read early days, so these are older books now, and if you understand the concepts in the books I'm about to mention very well, then I would agree that you have a good, solid understanding of options. So that would be things like Shelley Natenberg's, that's Options, Volatility, and Pricing. It was kind of like the first text that every options market maker in the 90s ever read. And if you read books like Hull, which was options, options, derivatives, and I don't know, so maybe somebody can look it up. That actually talked not only about options, but it also talked about some other derivative instruments, including some of the ones that I mentioned. And just so that everybody understands, there's a cornucopia, you could say, of derivative instruments that get traded by financial institutions, and I have not traded all of them. I didn't trade a lot of exotic options, but I did trade OTC derivatives. So, volatility and variance and dividend swaps and things like that. These are really straightforward, commonly traded instruments, and they traded a lot in the interbank market. I traded these things, and I've traded lookalikes as well as flexes and listed options, right? So that's really the sort of the plain Jane vanilla derivatives. I was not trading knock-ins. Actually, I did. I did synthetically construct some Asians and stuff like that, so knock-ins and knockouts. But those were really one-off contracts. And I don't think it's really important to understand and trade those things, because if you're self-directed, you're not going to trade them. You don't have an ISDA anyway. There's nobody who would trade them with you, even if you wanted to. And why would you? There isn't much of a reason for it. But I would read those two books. I would read Neil Criss. That's with two S's. Neil Criss ran a volatility hedge fund. He wrote a book called Black-Scholes and Beyond, which spoke a little bit about some of the more I'm not going to say complex, but more nuanced topics with respect to the underlying price behavior. So I think that could enrich your understanding. Did I read a book about, I don't know that we really read, when it came to things like dispersion and correlation, was there a book that really went into that? It was more papers. There's a lot of academic work that's out there. I think on the stat vol arb side, Rubenstein. So there's a model. It's kind of a derivative of the original. So the first, everybody's heard of the Black-Scholes model. Black-Scholes model is a closed form options model, meaning that you put the numbers in and you just get the answer. It's just a formula, inputs, outputs. That's it. The issue is that model is not that great for certain types of options pricing. So it's going to work really well for something like SPX options, where the SPX index is sort of a cash-settled index. There's no underlying dividends to consider, and you're dealing with European options. The more complex the underlying asset and the more flexibility you have with the associated options, the different models you want to use. There's something called the Cox-Ross-Rubenstein model. Rubenstein was also a professor, and we actually dealt with him in the late 90s on our dispersion and correlation strategies. So again, he probably wrote some papers. We were talking to him at the time, and some of the stuff that we did. I don't know that I actually read any books on that topic. I feel like we were doing most of our own work and research on it. But I think if you just read those three books, you'd probably be in good shape. But I don't know that it has so much value for most market participants, because on this you're getting into vol arb. The thing is, I will make this point. This is a general point. And that is that there's so many smart people focusing on aspects of options pricing that I don't think that most retail market participants, I don't think that you're going to find edge by coming up with a more sophisticated way to price an option than, 95% of market participants. And the reason is because that narrow group of participants who are actually making markets, Susquehanna, Citadel, Wolverine, Bluefin, where I used to work, it doesn't really matter, but they're good at what they do. Don't think you're going to beat them at that game. Parallax, which is a buy-side shop, you're not going to beat those guys at their game. That's not how you're going to make money doing this. I don't blame anybody for wanting to know exactly what they do and how they do it. But that's just not going to be where you find your edge, because they don't actually find their edge. Believe it or not, it's not because they're just a little bit smarter and they have a slightly better model and therefore they're able to squeeze a little bit more edge out. The reason that they make edge is because somebody wants to trade 5,000 calls and the screens are only 250 up, and so they call a guy at one of these places to make a market, and they clear the screens and he gets to buy it, a click and a half under fair. And you're not going to get, that's a time and place advantage. It's not a modeling or a knowledge advantage. So you're not going to get that. Your advantage is going to come from understanding the underlying a little bit better because the market makers aren't focusing on that. They're not worried about, they're worried about Micron earnings in terms of how the stock could behave in terms of its deviation, its vol. But they're probably not trying to mastermind whether or not the company's actually going to beat on the top line, beat on the bottom line, and whether this is a one-time blip or a longer-term trend. Those are the kinds of things, that's the art. So focus more on the art and less on the science, because the science is a pretty well-trodden path. You're competing against a lot of smart people with a lot of good tools and a time and place advantage, and I think that's a very tough battle to fight. I don't fight it. And I played that game. You know, that was my business. But I would never. I think it would be foolish for me to think that I can outdo D.E. Shaw or anybody else pricing options. I'm not gonna. There's no book that's gonna make me smarter than those guys. And I'm not at a huge disadvantage to them either if I was back on the desk and doing that for a living. But the fundamental work, paying attention to how the underlying stocks are behaving, you probably can find some edge on that. Relative to those guys. Because, you know, options market makers looking at 40, 50, 60 stocks. He's not going to be an expert in all of those things. He's focusing on vol. Okay. If Mike says, if young dividend shouldn't be a criteria for share stock selection, if retired, then dividend aristocrats are value add to an age portfolio. Agree. I'm older than you, Mike, 61. And you only buy strike. Okay. I see what you're saying. So if you're a young investor, the dividend shouldn't be a criteria for shares stock selection. And if you're retired, dividend aristocrats are value add in an age portfolio. Agree. Okay. So the bigger question is, younger investors, should they focus more on growth stocks, and older investors should focus more on income? So let me offer this, which is that income is a risk mitigation strategy, period. Ignore stocks for just a minute. If I have two bonds, okay, the bonds have the same, they're a similar level of seniority in the cap structure of a business. Business is ABC, it sells widgets, doesn't matter. So the company's credit worthiness, and I have two different bonds, both of the same maturity. So both mature in 10 years. So I have two 10-year bonds, same company, same seniority in the cap structure, but one is a zero coupon bond, and the other one is, you know, just pays regular quarterly coupons. Which one has more risk? Well, clearly the zero has more risk, right? You are taking, there's a 10-year sort of credit risk area, and you have more duration. So as you get older and you depend on, there's two big reasons why the higher dividends and the higher immediate income make sense in terms of where you are in your investment journey. One is that probably by now you are actually depending on the income where the early investor was not. You're essentially looking at companies that don't pay dividends. You're essentially reinvesting those dividends. If you're buying a growth company, you know, that makes perfect sense. So as you get older, you need less risk and you need more income, and having higher dividend paying stocks achieves both, right? You're reducing the duration of your portfolio. You're reducing the risk of your portfolio. If it was a bond, you'd be reducing. So yeah, the short version is I generally agree with that. But, you know, there's also there's a flip side of it. And the flip side is that that's asset dependent. You know, if you have assets sufficient that you don't depend on all of them to generate the income for you, then your risk tolerance, you might have a holding period that is indefinite, which is another way of saying that if I'm 75 years old and I have $1 million portfolio, I'm very risk sensitive. But if I'm 75 years old and I have $1 billion portfolio, I'm not at all risk sensitive because I'm not going to spend the $1 billion. That's a legacy investment. Its holding period is forever. I can think about that as the holding period of those assets is for my great-great-grandchildren. And they are a lot younger than a 20-year-old, right? They haven't even been born yet. So there's a couple things that work there, but yes, in general, I agree with what you're saying. Elamine, what effect on SPY does the JP Morgan collar trade have on and soon after options expiration? So if people don't know what he's referring to here. JP Morgan runs a really big hedged equity strategy where they have a collared S&P. And you'll see these big trades going on. They trade SPX options, not SPY options. But SPY options and SPX options are going to be related because it's very easy for market participants to choose one or the other. It doesn't really make that much of a difference. Do you buy puts in SPY? Do you buy puts in SPX? The volatility can't be that different because if they were, then I would say, okay, this guy just bought a ton of puts in SPX. SPX skew, put skew just went up a whole lot, but it didn't go up in SPY. So I'm going to sell puts in SPX and buy them in SPY. And now I have a stat arb on, right? So the relationship is pretty straightforward, which is that all else equal, if incremental demand is selling upside calls and buying downside puts, it's going to steepen put skew. What's put skew? For those who are new to this video or never heard of it or I haven't mentioned it, whatever. All I'm talking about is the relationship in implied volatility space, which is how options traders talk about the price of an option, of the downside versus the upside. Okay, I'm going to get rid of this because I don't want to. So this is it. This is SPX. So we can see here that an out of the money, a 40% out of the money put option, the implied volatility is 47.5 or thereabouts, mid-market as we sit. An at the money option, that's here, the 100% moneyness. This has an implied volatility of about 15.3, so much, much lower. The lowest implied volatility we see is about 10% out of the money calls. So if you're selling upside calls and buying downside puts, you can see that you're essentially selling the cheapest volatility on the board, buying expensive volatility, and then it starts to sort of go back up again. So the tails being high is indicative of kurtosis. Fat-tailed distributions have kurtosis, so that means that the tails occur with greater frequency than would be implied by a normal distribution. And the volatility around the mean is lower, so you have these sort of gaps. And that's what this is. You can look at this in a couple different ways. This is just percentage of the current price. We can also look at this in terms of delta, and you get something that looks like that. Or you can look at it in terms of sigma, that is how many standard deviations up or down. It's going to look a lot like delta. It's actually less like delta than I thought it would be, but it's generally going to be the same. Or you can just look at it on a strike-by-strike basis, and that's going to look like this. Now, this looks very straight, but notice that that's just because these strikes are actually really close together. So here's 6,000, and the S&P closed at what, 6150-ish, right? Oh, 6,100. It was. We were up a little bit earlier today. But as you can see, 92 points on a $6,000 underlying. I mean, that's only 1.5% away. So when we were looking at that smile before, we were dealing with options that were way further out of the money on the downside and way further out of the money on the upside. So that's the net impact. But one of the other things that can happen is that when that skew gets too out of whack, you could take advantage of that by saying, you know what, I'm willing to own a little bit of the underlying asset at some lower strike, sell puts, and I want to have some kind of breakout to the upside by owning some upside calls. And what ends up happening is you can get kind of asymmetric risk-reward relationships because that implied volatility dynamic is so different. And to illustrate this, let's just look at September month ending, okay? Haven't looked at these before. We're going to look at them for the first time together right now. So let's just say that I take a look at a 10% out of the money put. Right. So this is almost 100 days away. So 0.9 times. I'm just going to use 6. So that's going to be 54. So 54.82. That would be exactly 10% down, but we'll come up with something close. So we'll look at the 54.85s. Okay, so that's a $53 option. Okay. And 60.92. Now, don't forget, there's also, this is something important to remember, which is that there's a cost to carry. So calls should cost more than puts in general because they have to reflect the cost of carry, which is how much the risk-free rate is. So, bear that in mind. But then take a look at the 10% out of the money call. So those are about $11. So if you sold one 10% out of the money put, you could buy almost 10% out of the money calls, right? So that's the net effect of all of that skew, all of that put skew. And you could narrow that in and say, okay, well, I'm willing to get long 1 unit, down 5, to be long 2 units, up 5. And I actually can remember there was some situation, someone highlighted this, it might have been around 2017, very low vol, very high skew. And there was something crazy, like you could buy 5 upside calls, 5% out of the money to sell 5% out of the money put, like 45 days before the end of the year. So, look at those skews. The natural order flow is that people sell upside calls for income and they buy downside puts for protection. And the market generally rises. And, it can be selling those downside puts to finance upside can sometimes work out, especially when it gets really out of whack. So I would, if you're thinking about the dynamics that really big institutional market participants can have, that's one of them. But they're not the only ones, because as big as that JP Morgan hedge equity fund is, and it's huge, they're doing what a lot of people do. So they're kind of on sides with all of that kind of natural order flow. People like to buy protection. They like to collect income. And there is some negative skewness to equity prices. So that's one of the things that happened. We've chewed up more than an hour, so I'm going to try to punch through some of these because I really went into the weeds. I apologize for that, but I hope some of you guys found it a little bit interesting. Okay. Let's see here. I'm just going to go quickly to this question on NVIDIA because this is, I think this is relevant to a lot of people. And actually Michael Anthony Albertsons. Yeah, I made a comment about Albertsons. Kroger's. Yeah, remember Kroger's, I'd actually talked about the fact I liked it at 10. I talked about it many times on this channel, traded up to 15.5 times. And remember what I said before, sometimes things are cheapest right before things get worse, and they're most expensive right before things get better. Such was the case with Kroger's. I mentioned that you had this big multiple expansion from 10.5 to 15.5, and what happened? They beat. So the market was kind of telling us something there. So Joe Kamen says, I own NVIDIA and want to keep it. What strike or delta would you sell a call against it? 30 to 45 days to expiration. And my answer is, in the neighborhood of 15 to 20. I think that's a good amount of time to expiration that you've chosen there. And, if you keep it to about a 20 delta, that's an 80% market implied probability that you're not going to get assigned or that it's not going to expire in the money. A quick important point that I think is also, this actually, because we were talking about exotic options very briefly, there's something called knock-ins, knockouts, one-touch options, and so on. What those options, the specific feature of those options that make them interesting is that in a knock-in option, that means that the option is only effective if the stock hits a certain knock-in price. That makes it effective. Or a knockout means that the option is good unless the stock hits a certain price and that knocks it out. We have often talked about the probability that a stock is at or through a strike price on expiration, as measured by delta. When you sell a covered call and you've got 45 days to go, there is a slightly higher probability that a stock will hit that strike at any point in its life. Because if a stock's kind of trending upwards and it's going like this, there is, if you include all days between now and say 45 days to expiration, and it's a 20 delta call, bear in mind that the chance that the stock gets to that strike or through it at any point is actually greater than 20 delta, right? So that's the probability that it touches the strike. The probability of a touch is greater than the probability that it expires in the money. That's not something I've really spoken to that much, but because we were talking about exotics, it's kind of related. It's a different. It's a little bit more mathy, but you guys can probably do a little bit of homework on that. Maybe we'll touch on it in a future one. But that's what I would do, Joseph. Hope that helps you. Albertsons. I saw there was a lawsuit. Some random thing, some harassment thing I saw about them. It was on a social media post within the last couple of days on Albertsons. I don't think it's material. It seemed like a complete nonsense thing, but it caught my eye. But yeah, 10, 11 times earnings, I think it's probably reasonable, despite the competition from super grocers like Costco and Walmart. All right, folks, I've chewed up well more than my allotted hour of time, and I got into some pretty wonky types of subjects today. And if that bored the hell out of you, sorry, just speed through it. Put it on 1.5 playback speed. But still, come back and see us on our next live stream. I'm not sure that I'm doing one on Friday. For some reason, I think Mark is on holiday. I'll probably do one anyway. But I look forward to you joining me then. Thanks for watching.